Level 1. The intern. You're 20 years old, at a public state school, not one any fund prioritizes. You apply to 45 funds. 5 respond. 2 invite you to interview. 1 takes you. 1 is all you need. Day 1. You wear a suit bought on installments, worth more than a month's rent. You step into an elevator that climbs to a floor strangely quiet. Polished marble floors. Glass walls floor to ceiling. No sound except the murmur of keyboards and the hum of the AC. It looks like a library where people are silently betting millions of dollars. They seat you next to another intern. He went to Wharton, and he has a tic. Every few sentences he corrects how you pronounce a ticker, even when you say it right. My dad golfs with the fund's chairman, he says, unprompted. You nod, say nothing. You sit in meetings about positions worth more than your parents' house. You take notes, highlight things, write follow-up emails polished enough to frame. You do whatever's asked the second it's asked. You build slides comparing 12 fast food chains. You call 20 locations asking about holiday sales, pretending to be a customer asking about hours just to get real numbers out of the staff. Nobody taught you this. You figured it out yourself, then kept it from the other interns. One morning, another intern brings the wrong kind of milk in the portfolio manager's coffee. The whole meeting room watches in silence as he takes a sip, winces, sets it down. The intern apologizes 3 times that day. Nobody accepts the apology. There are 8 interns, 2 return offers, maybe 3 if the fund had a good quarter. Everyone's friendly on the surface, keeping score underneath. You eat lunch at your desk, read the S1 of a company about to IPO on the last bus home, by phone light. No social life, and you're paying for the privilege. College friends post photos from Bali. You like the photo, lock your phone, go back to the spreadsheet. One intern gets pulled into a 15-minute meeting with the portfolio manager. He comes out white-faced, says nothing. You feel the shift. The quiet competition gets less quiet. People start staying an extra hour nobody asked for. People start sending emails at 6 a.m. for the earliest timestamp. You realize this place runs on a fuel you never had a name for. Fear. Not exactly fear of failure. Fear of being ordinary. Everyone here used to be first in their class. Here, you're average. Average doesn't survive. At the end of summer, they shake your hand. Level 2. The junior analyst. You graduate, start full-time. The title is junior analyst. The real title is the person who takes on everything nobody else wants. In at 7 a.m., out at 9 p.m., some nights later. You don't trade. You don't make investment decisions. You feed a list of 200 consumer companies, updated constantly in a file you've named the graveyard, where rejected ideas pile up, longer every week. You learn the ratios that put normal people to sleep. EV, EBITDA, free cash flow yield, ROIC. You live inside Excel. A senior analyst hands you a coffee chain to research. You spend 2 weeks on it, reading every earnings call transcript from the last 3 years, calling a former regional manager, asking straight out why he left. Because the company cut hours to dodge paying for benefits, he says. That's data that doesn't show up in any filing. You write it into the memo. You present. The portfolio manager taps his pen twice on the desk, a tick he always does before saying no. This number doesn't tell me anything yet. You nod, go back to your desk, start the next one. It happens dozens of times. Each rejection teaches you something. The thesis too vague, the assumptions too rosy, the catalyst too far out. 11 p.m., the night before the investment committee meets, you're doing one last pass on the senior analyst's model before it goes to print. A formula is referencing the wrong fiscal year. The valuation is inflated by nearly 20%. You call the senior analyst. No answer. You text a screenshot of the error. 3 minutes later, a reply. Fix it. Send it back in 10. You fix it, send it, then sit staring at the screen until almost midnight. The next morning, in the meeting, the senior analyst tells the room, the number you're looking at is right, because someone on my team caught an error at midnight. He doesn't say your name, but the portfolio manager glances at you for exactly 1 second, then keeps talking. That 1 second is all you get. You learn that here, not making a mistake matters more than being right. Six-figure salary, bonus that could double it in a good year. Better than any friend outside finance. But the hours swallow your life. You cancel plans constantly. Friends stop asking because you always say maybe, and maybe always means no. You miss your sister's wedding because that week has a deal that needs closing. You call in from your desk during the ceremony. Camera off, just listening, still typing. You're 23, making more than your parents, and you have no time to spend any of it. Level 3. The Analyst. 2 years in, junior drops from the title. You're a hedge fund analyst now, where the real work starts. You own the consumer and retail sector. You're expected to know the 30 companies in your coverage better than almost anyone alive. You build relationships with management teams, attend conferences where CEOs present, sit in the front row with questions designed to reveal what they're not saying. You start waking up at 5 a.m. to stand outside a drive-thru, counting cars in line before it officially opens. You do this 6 weeks straight, in 6 different cities, paying for the cheap flights yourself. Nobody asked you to. You believe this company is growing faster than Wall Street thinks. You pitch your first real idea. A month of work, 60 pages, a model with 14 scenarios, plus a handwritten tally of cars. You walk into the portfolio manager's office. He taps his pen twice. You hold your breath, then stops. Give me the thesis in 2 sentences. You give it. He asks 3 questions about margins. You answer all of them, backed by numbers you counted yourself. He nods, puts $25 million into the position. You walk back to your desk, hands shaking. 3 weeks straight, the stock doesn't move. You check it every hour, wondering if the cars you counted actually represent the whole chain. Then the company reports earnings that confirm the thesis exactly. The stock jumps 19% in a single session. The fund makes over $4.7 million. The next morning, the portfolio manager walks past your desk and sets down a coffee you didn't order. Nice one. 2 words, 1 coffee. But it feels like a standing ovation. You learn something important. In this business, you're only as valuable as your last idea. You watch the senior analysts, how they frame an idea, how they push back on the portfolio manager without sounding like they're pushing back. You start learning the language of conviction, the one no classroom teaches. Level 4. The Senior Analyst. You run a team now, 2 junior analysts and a research associate. One of them, Kevin, always apologizes before asking a question. Sorry, this might be a dumb question, but you have to teach him to drop that habit before you can teach him to build a model. You send their work back covered in red, not sharp enough. Rerun the downside case. Where's this growth assumption coming from? You're the sector head. When a company in your coverage is about to report, the portfolio manager calls you directly, not the junior. Being wrong costs millions. Being wrong repeatedly costs your career. You have a relationship with a broker named Danny, who calls at 6 a.m. before you've had your first sip of coffee. Most of what Danny brings is garbage, recycled consensus repackaged. But once, he tells you a major supplier just lost a contract with a retail chain. It's data you'd missed, and it changes your view of the whole sector. You don't give him anything back. That's the game. Everyone's looking for an edge. One afternoon, on an expert network channel check call, a former operations director starts mentioning this quarter's revenue, unreleased. You cut him off immediately. Please stop. I can't hear unreleased information. You end the call, document everything, report it to compliance within the hour, exactly by the book. Material non-public information can turn an investment idea into a securities violation. Compliance commends you for handling it right. But you don't sleep that week, knowing that half a second's delay could have changed everything. Your income matters now. Base plus bonus puts you in high 6 figures. A good year clears 7. You buy a small apartment, wear a watch nobody notices unless they know what to look for. Expensive and understated, the aesthetic here. You realize success on this floor is quiet. The loudest people are the least secure. The ones actually making money rarely raise their voice. Level 5. The Portfolio Manager. You have your own book. That's what they call it here. $180 million, depending on how much the chief investment officer believes in you. You're a portfolio manager now. A PM. the two letters this whole industry revolves around. You decide everything. What to buy, what to sell, how much to size each position, when to cut a loser. Every gain, every loss, is yours. No one to blame, no one to share credit with. This is the purest meritocracy in finance. Your performance is a number everyone can see. One Tuesday morning, a European retailer in your book reports a loss because a port strike jammed the supply chain for 3 weeks. Something not in any scenario you'd modeled. The position loses $2.3 million in one morning. You sit there watching the screen, not moving. You size positions more carefully after that. Sizing is everything. A great idea sized wrong is a wasted opportunity. A mediocre idea sized too big is a disaster. Some mornings you're up $1 million before breakfast. Some mornings you're down because a false rumor about a CEO resigning spreads across a trading forum. The pressure isn't the hours. The hours are actually easier than being an analyst. It's the weight of knowing real money is on the line. Your money, your investors' money, your reputation. Every open position is a question you already answered with capital. Level 6, the Senior Portfolio Manager. Your track record holds through 3 years of steady returns. Not spectacular, but in this business, steady is spectacular. Anyone can have one good year, even a monkey throwing darts. The funds that survive are the ones that don't blow up. You haven't blown up. Your book is over $1 billion now. You have your own trader, a team of analysts, an operational infrastructure, keeping the whole thing running smoothly. You're a small business inside a bigger one. In a good year, your personal take is 8 figures. You remember the near miss in 2021, when a short position got caught in a squeeze, an online group tripling the price in 4 days. You had to close it at a loss, swallow it, and learn to respect what doesn't show up on a balance sheet. You meet a pension fund allocator from Norway, who always asks the same question: what makes you confident you're right when the whole market disagrees? You have a polished answer ready, one that never mentions that night in 2021. There are other senior PMs in the fund, running different strategies, sharing infrastructure and the name on the door, but competing for capital allocation from the CIO. You've watched people get their capital cut after a bad year, watch talented investors lose their nerve after a drawdown, and never get it back. Money doesn't make people greedy. It makes them afraid. Level 7, the Director of Research. The firm asks you to lead the entire research platform. Director of Research. You oversee every analyst, every sector, every idea, flowing into every portfolio. Hiring might be the most important thing you do. One great analyst generates tens of millions in profit. One bad one burns capital and wastes a year of the team's time. You interview a young candidate who used to work at a smaller fund. She pushes back directly on an assumption in the test you gave her. Most candidates just nod along. You hire her on the spot. Exactly the kind of person you need. Someone who sees what the models can't. You build a culture where analysts can say, "I was wrong," without flinching, where they're encouraged to push back on portfolio managers. You want friction. Friction is useful. Disagreement makes the output better. One of the fund's star PMs pressures a young analyst to change a rating from sell to hold on a stock he holds a huge position in, not because the data changed, but because he doesn't want to see a recommendation that contradicts his own position. The analyst comes to you, shaking, afraid of losing her job if she refuses. You hold a private meeting with the PM, restate the principle. Independent research doesn't serve anyone's position, not even the most senior PMs. He's unhappy, reports you as uncooperative to the CIO. The CIO backs you. It's the first time you realize your position carries real weight, not just leading research, but protecting it. You also catch 2 other PMs in the fund taking opposite sides of the same retail trade, one long, one short, neither aware of the other's position. You flag it up the chain. One listens, trims the size, the other doesn't. 3 months later, the market proves the one who didn't listen wrong. Your own trading has taken a back seat to everyone else's spotlight. You remember it. The feeling of your hands shaking when your first position got funded. Level 8, the Chief Investment Officer, CIO. You sit at the top of the investment hierarchy. Every dollar the fund deploys runs through your framework. You set risk limits, approve strategies, allocate capital to the PMs. You run stress tests. What happens if retail workers go on strike nationwide? If a major retailer files for bankruptcy overnight? If interest rates spike in a single quarter? You talk to the founder every day, his right hand on everything investment related. Sometimes you agree, sometimes you don't. You've watched a CIO get replaced for disagreeing too much, and another get replaced for never pushing back at all. The line is invisible and always moving. You represent the fund publicly, choosing your words carefully because a single comment can move markets. At a dinner with a few financial journalists, you let slip that you're watching a specific retail chain. The next morning, the stock jumps 4% before the open because someone at the table leaked it. You never have dinner with journalists again. Your income runs into the tens of millions in a good year. Your name is known in the industry. Headhunters call every week with offers. Other funds want your process, your track record, your reputation. You could leave any time you wanted. Level 9. The managing partner. You're no longer just an investor. You run a business. The managing partner runs the fund like an institution. Capital raising, investor relations, legal compliance, regulatory filings, office leases, hiring, firing, all of it. The fund has $9 billion under management. Management fee at 2% is $180 million a year before a single trade is made. Performance fee at 20%. In a year, the fund returns 12%. That's another few hundred million. One Monday morning, a letter from the SEC requests every email, every trade log, every channel check recording from the last 60 days. A routine exam, or maybe not. Nobody's sure. You spend 3 weeks with outside counsel and the chief compliance officer, combing through emails, prepping staff for interviews with examiners. Nobody's accused of anything, but the feeling of every message being scrutinized keeps the office tense for nearly 2 months. Eventually, they close the file. No further action. You learn that at this scale, even doing nothing wrong requires being able to prove it on paper. A family office representative insists on calling only Sunday evenings, the one time the boss is free. You take the call in your own kitchen, answering the same questions you've answered hundreds of times, while your kids wait for dinner. The economics of a large fund are staggering and fragile at once. One bad year, investors redeem, fee revenue drops, your best people leave. The spiral can destroy a fund in 18 months. You fly to Oslo, Singapore, Toronto, sitting in rooms with people who control more capital than some countries. Level 10. The founder. After years as CIO, then managing partner, you leave to start your own fund, not out of frustration, but because you want something that's entirely yours. On day one, you sit in a shared rented office with a folding table and $22 million to start. Most of it, $18 million, came from a seeder fund, a firm that bankrolls new fund managers in exchange for a cut of profits over the next 5 years, betting on the track record you'd built over your years at the old firm. The rest came from a college friend who'd gotten rich off equity in a tech company, plus your own modest savings, withdrawn early with a penalty. Year 1, you returned 19%. Year 2, 14%. Year 3, you lost 7% on an oversized bet in a retail chain that seemed like a sure thing. A few smaller investors you'd brought in after the first round pulled out the moment their lockup ended. The seeder held to its contract. Your friend in tech, under no obligation at all, could have pulled out any time. He didn't. He said, "I believe in how you think, not in 1 year of yours." You remember that line forever. You learned something business school never taught you that year. People love you when you make them money, and disappear when you don't. You built the team one person at a time. You hired your first PM from a fund where he was underrated and wasted. You hired your fund of research from a competitor that fired her unfairly for pushing back on her boss. Every person who walked through the door was a bet. Some paid off spectacularly. Some cost you millions in bad trades and months of recovery. The fund grew. $22 million became $250 million, became $2.8 billion, became 6.5 billion. Every added zero changed the nature of the business, from trader to investor to institution to target, watched by regulators, competitors, journalists, short sellers. 20 years passed since you signed that first check. Success made everything harder. You're in your late 50s now. Your name is on the door, your photo in the financial press more times than you can count. It's not intelligence that did this. The industry is full of smart people who failed. It's the ability to be wrong without breaking, to lose money and still trust your own judgment, to sit alone at 6 a.m. staring at a screen that says you just lost $130 million and still make a clear decision about what comes next. Your net worth is 9 figures, maybe 10. You own homes in places you used to only see in movies. You donate to the public school you went to, not a prestigious one, the one that once turned you down for a scholarship your freshman year. You sit on boards, attend events about philanthropy, about politics. But you still come into the office every day. You still watch the markets before sunrise, read research, argue about positions. Not because you have to, but because it's the only thing that ever made you feel fully alive. The market doesn't care about your name, your reputation, or your net worth. It tests you new every morning. A few miles away, on the night shift at a warehouse, a young worker is looking at a stock chart on his phone during his 15-minute break. His coworkers think he's crazy, reading financial filings between shipments. He can't quite explain why. He just knows something about those numbers makes his mind sharper than anything else does. He'll apply for internships this summer. He'll get rejected by most of them. He'll get one offer. One is all he needs. He has no idea what he's walking into.